Please listen closely because the way money and the world work is in big trouble, even though you might not see it yet. Ray Dalio described the situation as a quiet storm that's already hit, but you don't know it because the thunder and lightning haven't arrived. As we delve deeper into the intricacies of market evaluation, it becomes apparent that there are two crucial realizations that investors must embrace. The first of these is the understanding that cash, long regarded as a safe haven, may no longer offer the refuge it once did. Inflation lurks in the shadows, silently eroding its value, and interest rates remain pitifully low, failing to compensate for this insidious tax that eats away at the purchasing power of money. In this light, it is advisable to steer clear of the seemingly tranquil waters of cash. The second revelation that demands attention is the art of portfolio balancing. Portfolios, much like the ebb and flow of tides, are subject to the whims of various market forces. Equities waver as growth expectations wane and the prospect of monetary easing becomes more likely. Gold and other markets watch attentively, reacting to these daily market dynamics. It is in these fluctuations that wealth is not so much destroyed as it is transferred. Enter the concept of the all-weather portfolio, a masterful orchestration of asset allocation. Skillful portfolio management allows one to mitigate risk without compromising returns. It is a sanctuary where market timing is rendered obsolete, as even the most adept market prognosticator is beholden to the capriciousness of global events that can reshape the financial landscape in an instant. Returning to fundamentals, we find a universal truth that applies to individuals, corporations, and governments alike. One must earn more than one spends, maintain a balance sheet, and reconcile an income statement. The allure of becoming a reserve currency, with the power to borrow and create money at will, is undeniable. This exalted status, enjoyed by few, grants an array of privileges, including the imposition of sanctions through the almighty dollar. Nonetheless, history teaches us that currencies are not immune to devaluation or even outright destruction. When bonds and debt instruments in a particular currency lose their appeal, a supply-demand conundrum ensues. Bonds, essentially promises to receive currency, make their holders implicitly long on that currency. Yet, the printing press lies with the issuer, a factor that tilts the balance of power in their favor. In the grand tapestry of financial markets, there are shifts, ebbs, and flows, and those who wish to thrive within this intricate ecosystem must learn to adapt. The world of finance is a realm where predicting the future is a Sisyphean task, and it is through the mastery of portfolio management and the understanding of economic forces that one can hope to navigate the turbulent waters with some measure of assurance. Is happening because they are accounting for a larger share of world trade. This shift in trade dominance has significant implications for the global economy, particularly in the context of our current monetary system. In a fiat monetary system, like the one we are currently operating in, governments can create money out of thin air. This allows them to run large deficits, which they then monetize by issuing bonds that need to be sold. However, the demand for these bonds is limited, as there are only a few major buyers in the market. By examining their portfolios and calculating the supply and demand dynamics, it becomes clear that there will not be enough demand for these bonds. This creates the need for further monetization of debt. This process of monetizing debt has already had a profound impact on the global markets. When the Federal Reserve engaged in asset buying to stimulate the economy, it not only led to a decline in real interest rates, but also injected a significant amount of liquidity into the system. As a result, there is now an abundance of liquidity bidding for financial assets worldwide. However, this increase in the money supply and the supply of bonds ultimately diminishes their value relative to other assets. Consequently, there is a shift in the storehold of wealth, similar to what happened during the Roosevelt era in 1933. During that period, assets rose in value as investors sought alternative storeholds of wealth. This liquidity move also affected assets. Ray Dalio shares a profound perspective on China and its economic evolution. With over 4 decades of experience in the region, Dalio's insights into China's leadership, their strategies, and the global implications of these developments are invaluable. Since 1984, I've had the privilege of immersing myself in China's economic landscape. I've forged relationships with its leaders, gained deep insights into their thought processes, and closely tracked their strategic moves. My purpose here is to convey this unique perspective, recognizing that many find it challenging to comprehend the intricacies of China's economic journey. It's imperative to acknowledge that China's success story, since my initial visit in 1984, has been nothing short of remarkable. Per capita income has surged by a staggering 26 times during this period. Failing to comprehend this transformation or approaching it with preconceived biases would be a disservice. One critical element at play here is the concept of common prosperity, which is currently a global topic of discussion. The world is witnessing a growing movement towards achieving common prosperity, and China is no exception. However, it's essential to clarify that this doesn't entail a sweeping confiscation of wealth. In fact, the so-called progressives in Western countries often have more left-leaning ideologies compared to the policies being pursued in China. The essence of common prosperity is rooted in the question of how to achieve it on a technical level. It doesn't involve a communist-style seizure of wealth. Instead, it contemplates achieving prosperity through enhanced productivity. China is poised for significant productivity gains, and diversifying one's investment portfolio, both within China and globally, is a prudent strategy. Furthermore, when we examine capital flows, China is emerging as an attractive destination for investment. A striking statistic to consider is that over 40% of initial public offerings, IPOs, are now taking place on Chinese stock markets. Capital tends to gravitate towards regions with burgeoning financial markets, as history has demonstrated. For instance, during the Dutch Empire, Amsterdam was the financial epicenter, and London held that position during the British Empire. In the case of the United States, New York assumed prominence. Similarly, we are witnessing China's ascent in this context, which inevitably influences supply and demand dynamics and poses a potential challenge to the reserve currency status. In contemplating the current economic landscape, envision it as a state, Connecticut, Illinois, and others, devoid of the ability to print currency at will. In such a scenario, the options narrow down to two fundamental choices: raising taxes or slashing expenditures. As we delve into history, we discern a recurring pattern within these empires, where the imposition of higher taxes or severe budget cuts invariably stirs the cauldron of conflict. Indeed, it is not a stretch to assert that these fiscal decisions often serve as the spark igniting civil wars throughout history. Certainly, one might argue that the path forward seems straightforward. We must generate more income than we expend. However, our contemporary milieu is far from simplistic. We dwell in an era characterized by profound fragmentation, where the pursuit of fiscal equilibrium poses a complex challenge. This perplexing quandary led me to embark on a journey of introspection and investigation within the confines of Bridgewater. Over the course of my lifetime, I've gleaned a critical lesson. The most formidable surprises and blunders I've encountered emerged from occurrences that lay beyond my personal experience, but held precedence in the annals of history. Allow me to illustrate with an example from 1971, when I was serving as a clerk on the New York Stock Exchange. August 15th is etched vividly in my memory, for it was the day President Nixon made an unprecedented proclamation: money as we knew it would undergo a transformation. European markets promptly refused to accept US dollars, and I stood on the trading floor, convinced of an impending crisis that would send the stock market plummeting. Yet to my astonishment, the market surged. This enigma spurred me to delve into the historical archives, uncovering a parallel event on March 5, 1933, during Roosevelt's era, a devaluation that led to a reflationary surge. It was then that I grasped the intricate dance of devaluation and reflation and its profound impact. Fast forward to our contemporary milieu, where I've discerned three momentous developments hitherto unprecedented in our lifetimes, developments of colossal magnitude. These developments have propelled me towards a profound historical inquiry. The first is the intricate interplay between money and credit as interest rates plummet to the abyss. The second entails the creation of substantial debt volumes, meticulously orchestrated by central authorities and channeled towards specific objectives that elude the grasp of conventional capital markets. Although the clarion call of this phenomenon resonated loudest during the COVID-19 pandemic, its roots predate the crisis. Lastly, these inquiries lead us inexorably to the delicate equilibrium of money and credit supply and demand. The first factor discussed by Dalio is the intrinsic connection between markets and our daily lives. He emphasizes the pivotal role markets play in driving various aspects of our society. From economic stability to personal investments, markets have a profound influence on our everyday existence. Moving on to the second factor, Dalio delves into the emergence of populism and the widening wealth gap. He highlights the significant increase in populism worldwide, with a particular focus on the election of Donald Trump as the President of the United States. This phenomenon, according to Dalio, was not previously as prevalent in developed countries. To understand the extent of this wealth disparity, Dalio examines the distribution by studying the conditions of the bottom 60% of the population. Alarming findings reveal that the wealth gap today is the largest since the 1930s, a period characterized by zero interest rates and extensive monetization. The conflicts arising from this wealth disparity mirror the happenings during the same period, once again highlighting the historical significance and potential consequences of this issue. The third factor, as elucidated by Dalio, focuses on the rise of a great power challenging an existing great power. He points out that the current world order was established in 1945, with the United States assuming a dominant role after emerging victorious from World War II. With half of the global economy and 80% of the world's gold, the United States established a dollar-based order that shaped the international landscape. However, the Soviet Union, while a nuclear power, did not pose an economic threat comparable to the United States. Presently, we witness this rivalry being mirrored in other spheres, and understanding the decision-making processes and dynamics of these powers becomes crucial in projecting future developments. Having analyzed these three factors, Dalio comes to a realization. To comprehend the present, it is imperative to study the historical cycles that have shaped financial systems. Therefore, he embarked on a comprehensive study spanning 500 years, examining the eras of the Dutch, British, and American empires. Such historical exploration enables a closer assessment of what determines a reserve currency and the factors that contribute to its rise or fall.